In this presentation, we will continue on with our corporation comprehensive problem recording the journal entry related to cash received on account. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Information will be in the top left. We're going to enter that into our general journal, then post it to the general ledger, and then create the changes to the trial balance from it. We have the received payment for work done on account on 1/18, January 8th. So first question I'm always going to ask, is cash affected? We're going to say, yeah, received payment. So we don't need to go any further than that. We can say, okay, received payment in terms of a journal entry, that means cash is affected. Cash has a debit balance. We're going to make it go up by doing the same thing to it, which in this case is another debit. So we're going to debit the cash. Then we're going to credit something for the $4,000, and it's just a matter of what are we going to credit. Now, if you think about it, we're getting cash. Why would people pay us cash? Probably because we do whatever we do as a company. We did work, earned cash. The only question really is, typically when we get cash, the question is, well, when did we do the work? Did we do the work before we got paid? Did we do the work at the same time we got paid? Or did we do the work after we got paid? And that's gonna determine then, remember that of course, according to the revenue recognition principle, we only record revenue when we do the work. So the question is, did we already record the revenue because we did the work in the past? Do we need to record the revenue right now because we're doing the work now at the same time we got the cash? Or are we gonna have to record the work in the future because we haven't yet done it? In this case, it says we received payment for work done on account, on January 8th. So we did the work in the past. That's what this is going to mean. In real life, this would be very clear, meaning if we were a bookkeeper, if we did accounting in the past, if we did bookkeeping work in the past, and then we got paid for that bookkeeping work, we would have known that we invoiced the client in some way, and now we've got paid for it. In a book problem, they're going to have to tell us that. They may say that we got paid cash for work done in the past. They may say we got paid cash on account or on credit or something like that. So the other side then is going to not be going to revenue or expense, but decreasing the accounts receivable. So what really happened here is we got our favorite asset, cash, is going to increase, and then we're decreasing our second favorite asset, which is accounts receivable, which we would hope to convert to cash soon. Now again, we already know that we're going to credit it because we debited cash, and that's what we had to do to it because we debited cash. But if we think through it, does that make sense? Our accounts receivable has a debit balance. It needs to go down because if people paid us cash, they no longer owe us it anymore, and therefore we need to decrease it. How do we decrease it? We do the opposite thing to it as its normal balance, a credit. So that makes sense. Now we're gonna go through these two accounts then, look for them on the GL, which will be very easy because they'll be our first two accounts, and then we'll post to them. So here's our GL, here's our cash and accounts receivable. We're going to zoom in on the cash and accounts receivable and post this transaction to it. So here's our journal entry in the general journal. We're zooming in on these two accounts, cash and accounts receivable. Cash has the most transactions in it. We're left at 26,000 prior to this journal entry. We're going to post the 4,000 debit. So here's the 4,000 debit, taking the 26,000 up by 4,000 to 30,000. Then we're going to post the other side, accounts receivable. Here's accounts receivable. It had 12,000 in it. We're going to decrease it, but we're going to credit it, which will decrease it because it's a debit balance account, by 4,000. So here's the 12,000, credit 4,000. 12,000 minus the 4 brings the balance down to 8,000. Now we're going to use this new balances, the 8,000 and the 30,000, cash and accounts receivable, or accounts receivable and the cash, respectively, to make or adjust the trial balance. So here's the trial balance, and we're just adjusting these top two accounts. Here's the cash account, adjusting cash. Now again, yours is probably here. You don't have to repeat the 30,000 all the way down, but that 30,000 is being used to adjust the cash account. And then the accounts receivable, the arrow is kind of in the way, but that's 8,000 that's going from this accounts receivable to create that accounts receivable. All the rest are coming from the GL as well, but there was no change to the GL since the prior transaction, so those all remain the same. Once we do this, we always want to add up the debits minus the credits. So we'll add the debit plus the debit plus the debit plus the debit minus the credits minus credits minus the credit. That should equal 0 if we are in balance. If we look at the activity that happened then, we're going to say that cash went up. That's an increase to assets. Cash, and then accounts receivable went down, decreased to an asset. So in terms of the accounting equation, assets went up, assets went down. No effect, in other words, to the orange accounts, the liabilities, or to any of the blue accounts, the equity, including no effect to the income statement, no effect to net income. So even though we got cash, in other words, that does not equate to net income increasing or any activity in the income statement. Why? Because revenue had already gone up, not at the point of time when getting the cash, but in the past when we had earned the cash, when we put it on the books into accounts receivable. That's when the revenue was charged in accordance with the revenue recognition principle. Right now, we already showed the asset represented by that revenue. It was just in accounts receivable, and now we're converting it from our second favorite asset to our first favorite asset. For more accounting information and accounting courses, visit our website at accountinginstruction.info.